and last name.
Good afternoon. My name is Sean. I'll be your conference operator today. At this time, I would like to welcome everyone to the NSP Program Income webinar. I'd now like to turn the call over to Mr. George Martin. Sir, you may begin.
Thank you, Sean. Good afternoon, everyone. My name is George Martin. I work with TDA. We're one of HUD's technical assistance providers, and I will be providing technical support on today's webinar. Welcome and good afternoon to today's NSP webinar on program income, basics, and closeout requirements. In just a few minutes, I'm going to turn it over to my colleague Jennifer and our HUD folks who will be going through the material today. But first, I'm going to walk through some technical instructions on today's webinar. I want to start by reminding everyone to please clear distractions away from your desk, close email and other programs on your computer, and silence phones whatever phones are around you that you're not using to access this teleconference, and so you can give your undivided attention to today's presenters. If you have any technical problems, you can call my colleague here in the office who will help you. Her name is Vicki Grimm, and she can be reached at 443-875-8477. Or if you're able to connect to the webinar but you're still having trouble, there's a chat panel on the right-hand side. If you use that and send the message to the host, that's me, I'm the host, and I will work with you to resolve your issue. So all participants, all of you have been muted, and we do that because there's a lot of us on the line, and that way everyone can pay attention to our presenters. But we want you to ask questions today, and you'll be able to do that after the initial presentation in two different ways. First is verbally via the conference call, and also there's a Q&A tool in WebEx that you can use to submit written questions. So to ask questions verbally, when you are listening to the presentation or listening to other people's questions and you know you have something you'd like to ask our HUD experts, you can press *1 on your telephone keypad, and that will add you to the queue, the question queue, and then the operator will introduce you when the time comes to give verbal questions. If you realize that your question has been answered while you're waiting in the queue, you can simply press *2 to remove yourself. So you can also submit written questions, and we do that using the Q&A tool if you look at the Q&A panel on the right-hand side of your screen. You can simply type a question into the field on that panel, and then you click send, but before you do that, you want to make sure you're sending the question to all panelists. That makes sure that we're all getting the questions and we can get them answered as quickly as possible. And so on that note, I am going to turn it over to my colleague, Jennifer Alpha.
Great. Thank you, George. So today's webinar is on program income basics, closeout and closeout requirements. This session is going to provide an overview of program income regulations as well as program income considerations at closeout and beyond. And then we'll also be talking a bit about using the revolving loan fund as a tool to manage your program income. As George said, you'll have an opportunity at the end of the presentation to ask questions, and we'll review those instructions quickly before we open it up for questions so that everybody understands how to participate. I'd like to remind everyone as well that this session is being recorded and an archive will be created on the OneCPD Resource Exchange website. The archive will include an audio-visual recording of the webinar and PDFs of the presentation slides as well as a written transcript. Before we begin going through the presentation slides today, I wanted to introduce the folks who are joining us from HUD. We have Paul Patterson, Hunter Kurtz, Larry Reyes, and we also have John Laswick. So hi everybody, how are you doing?
Good afternoon.
Hello, great. Thanks for having us.
Good, great. Okay. So moving on then, as we said, today's topics, we're going to give you a little rundown of some program income resources that are available to you so that if you want to look at some of these issues in more depth or you kind of need a refresher at any point, you'll have those resources available to you through these slides. We're also going to go over the basic regulations for program income and talk about the very recent waiver for NSP2 grantees, hot off the presses just a couple weeks ago. So that'll be some new information that we're presenting here today that you may not have heard before. We're also going to talk about the treatment of program income at closeout as well as after closeout and some exceptions that are included in those post-closeout requirements. And then finally, we'll go over using program income for revolving loan funds. And all of these topics that we're going to talk about today, you can find more information on them in those resources that I will go over just right now. So these program income resources on this slide are all written materials. So we've got the NSP Combined Program Notice from 2010, a policy alert on program income, also a policy alert on revolving loan funds specifically. So if you are interested in setting up a revolving loan fund, we'll give you an overview of the basics today. But if you want some more in-depth guidance, you can go to that policy alert from 2012. And then we've got Closeout and Recapture Notice, and then that hot off the presses waiver for NSP2 grantees dated just a couple weeks ago, January 28th. And then, of course, you have the CDBG regulations. In addition to those print resources, we also have webinars that are great tools for you to access. And all of these can be accessed on the 1CPD Resource Exchange at 1cpd.info. There's a webinar on program income, activity delivery, and general administration, greatest hits of program income, DRGR updates, and effective use of NSP2 program income, and then program income and NSP administration strategies post-closeout. So if you're interested specifically on more detail about post-closeout program income, you may want to listen to that webinar because it's specialized for that topic. So there are also FAQs on the Resource Exchange that you can search if you have a particular issue that you might want to see how it's been dealt with in the past. Okay, beginning with program income basics. As most of you probably know, program income is the gross income received by a grantee or a subrecipient from the use of program funds. Now, some of these examples include proceeds from the sale or lease of property acquired, rehabbed, or redeveloped with NSP funds, proceeds from the sale of equipment purchased with NSP funds, gross rental income from property acquired, rehabbed, or redeveloped with NSP funds, and principal and interest earned on NSP loans. And again, this is all income that would be received by a grantee or subrecipient from the use of the original program income funds, or original program funds. That income that comes back is program income and would be subject to the program income regulations. I'm going to take a minute just to talk about what program income is not, because that's also important. Program income is not earned by a developer. So income earned and retained by a developer is not program income. It's important that you take a look at your developer agreement to ensure that that developer was not designated as a subrecipient, because as we noted on the last slide, subrecipient income that was generated from the use of program funds is program income. But as long as your developer agreement shows that they were not designated as a subrecipient, then that income is not treated as program income under the regulations. And then you also want to double check that your developer agreement does not require the developer to return income to the grantee or the subrecipient. Because again, any income coming back to the grantee or subrecipient that was generated from those original program funds will be treated as program income. more on basics here. For NSP1 and NSP3 grantees, program income must be spent before the line of credit funds. And so before you draw down any program income, you will be required to spend the line of credit funds. Before you try to draw down any line of credit funds, you will be required to spend the program income first. And that's for NSP1 and NSP3 grantees. Now the new news is that there was a waiver released on January 28th, and that new waiver allows NSP2 grantees to spend program income in advance of line of credit funds. And this is important because it assists grantees in meeting the September 30th, 2015 spending deadline. So by allowing you to access those line of,
Jennifer, just real quickly, that September 30th, 2015 spending deadline only applies to NSP2 grantees.
Yes.
Just want to emphasize that.
Thank you. Yes. Only for NSP2 grantees, so everybody else, NSP1 and NSP3, you don't have to worry about that deadline. But for the NSP2 grantees, there is an upcoming September 30th deadline, and this waiver allows you to access your line of credit funds first before program income, which we know is an exception to the general rule. Now this applies only to those 42 NSP2 grantees that are listed on the waiver publication, and you can find that on the Resource Exchange. And then in addition, there are DRGR instructions available along with that publication release, and there's the website there on the bottom of the slide to access it. Essentially, in DRGR, it's a pretty simple process. You're going to create a new project and activity as a temporary place to house the program income. You'll then create a new program income account, and then you'll receipt all your incoming program income to that account, and then you'll also revise the existing receipts of program income so that the program income you have on hand is being held in that new account. The instructions are very detailed and really walk you through the process quite nicely. But if you do attempt to set this up and you have any questions, you can always submit an Ask a Question to get some one-on-one guidance with setting up those program income accounts. Okay, just some closeout reminders regarding program income. We often get questions about what will happen to folks' program income at the time of closeout. Well, grantees will retain any program income on hand at closeout and generated following closeout. So when you go to close out your grant, any line of credit funds that you still have on hand, if you choose to close out at that time, will be swept back into Treasury. However, your program income that you have on hand will remain with you. So you retain that program income at the time of closeout. Now, if the 25% set-aside requirement is not met for program income at the time of closeout, then the grantee has 3 years to meet that requirement. When you close out your grant, you will have had to have met the 25% set-aside requirement for all of your line of credit funds, that amount that you were originally granted. However, if you haven't met it for the program income that you have on hand at time of closeout, you do have an additional 3 years to meet that requirement. Program income is earned in perpetuity for most grantees. There is an exception for those grantees with no open CDBG grants. But in perpetuity, any income that comes back after closeout will be treated as program income for most grantees. And then after closeout, you will be reporting your program income annually through DRGR. So keeping a careful accounting of your program income receipts is still important even after closeout. So uses of program income following closeout, generally it's going to be just like it was prior to closeout. You can use your post-closeout program income for NSP administration and eligible activities. These activities must meet an NSP eligible use. It must be an eligible activity, not limited to target areas. It has to meet a national objective, and again, you'll be required to meet the 25% set aside with some special exceptions here that we're going to go over in the upcoming slides. There are some special requirements depending on what type of grantee you are and the program year, so whether you're an NSP1, 2, or 3 grantee. And then the grantee program income below certain annual thresholds will be treated a little bit differently. So let's go ahead and start talking about those different categories. So in Category 1, again, depending on your program year and the type of grantee you are, you're going to be treated a little bit differently after closeout with respect to program income. So for NSP1 and 3 state and entitlement grantees, NSP2 state and entitlement grantees who are part of a consortium, and then NSP3 non-entitlement grantees with an open CDBG grant, and that's the important part there, open CDBG grant. For these types of grantees, the following requirements will apply. Any income generated for the duration of the NSP program must be used for NSP eligible activities that meet a national objective. So even after closeout, if you're one of those grantees that I just mentioned, your use of the program income will have to meet a national objective. If program income does not exceed $25,000 per year, then you can use those funds for administration, or you can include them in a CDBG activity. So that's the $25,000 threshold. Now, if your program income exceeds $250,000 per year, if you have a pretty hearty program income return, then you will be subject to the 25% set-aside requirement. Our second category here is for those NSP3 non-entitlement grantees with no CDBG grant open at closeout, and for NSP2 nonprofit leads and members of consortiums, and as well as NSP2 nonprofit direct grantees. So if you have no open, if you're a non-entitlement with no open CDBG grant, or you're a nonprofit consortium member or direct grantee, then the following requirements will apply to you. This is broken out sort of in the first 5 years after closeout and then beyond. So income received prior to closeout must meet all NSP requirements, as always. And then the income received during the first 5 years following closeout must be used for NSP eligible activities that meet a national objective. Other cross-cutting federal requirements, however, do not apply in this first 5 years following closeout as you're meeting your national objectives with your program income. And these include things like environmental and Davis-Bacon. Now, once you get past those initial 5 years following closeout, for those few grantees that I named there in this category 2, the income received will be then treated as miscellaneous revenue. And these funds are not subject to ongoing NSP or CDBG program requirements. However, HUD does encourage nonprofit grantees to use these funds in the same manner. And if you look at the closeout guide, well, we'll look at that slide in a second, but first I want to talk a little bit about state grantees. There are some special things that state grantees want to keep in mind here. Program income policies will likely be set by states on how the states will allocate any future program income that is received after closeout. The program income is aggregated at the state level, even if it's retained by subrecipients, and it's going to follow that $25,000 rule that I mentioned before. And then states must report and are responsible for program income that's earned annually, and that reporting is done through DRGR. This is a slide that is taken from the closeout guide. If you go onto the Resource Exchange and search for the NSP closeout guide, you can get a lot more information on the treatment of program income following closeout, including this chart here, which gives you a breakdown of the two types of grantees that we talked about on the left side here, categories 1 and 2, and then going across it shows you how that program income will be treated, whether it's less than $25,000 or if it exceeds $25,000, and then if it exceeds $250,000 per year, and then how reporting is required. So it's a nice handy chart for you to access quick tips on how program income will be treated following closeout. Okay, and then on the last part of our presentation here, we wanted to talk a little bit about revolving loan funds, because revolving loan funds are a tool for managing the flow of program income. These funds may be operated by either a grantee or a subrecipient. It does need to be funded with your program income, and then these funds are tracked separately from other line of credit funds and other program income. So essentially, you're taking your program income, you're creating a sort of separate account for that program income, and then those funds are tracked separately. So you would use those funds specifically for the activities that the revolving loan fund is set up for. And then these funds will be dispersed and replenished again and again in perpetuity. So as you use funds from your revolving loan fund to fund your activities, any program income that comes back will come back into that account, and then it will be redistributed again from that account. And so it's really a way to sort of segregate that set of funds for that particular activity. Each revolving loan fund must be set up for an NSP eligible income generating activity meeting an NSP national objective. So all the rules still apply, NSP eligible activities meeting national objectives. Some examples of a revolving loan fund may be for loans to purchase and redevelop foreclosed homes and residential properties. You may use it to fund a loan loss reserve, or you may use it for shared equity loans for low and moderate income home buyers. So just some examples of activities that might be good for a revolving loan fund. Now, setting up a revolving loan fund, there are some things you want to keep in mind, because it is a very useful tool for being able to manage the flow of your program income. However, it may not be for everyone. So it will require you to amend your action plan, and the revolving loan fund must be for a specific activity. So it can't be set up as a general account for multiple activities. You must designate it as a revolving loan fund for a specific activity, like those examples that we just mentioned. You'll be capitalizing the revolving loan fund from your program income. There are separate accounts for each revolving loan fund. So each activity that you set up a revolving loan fund will have a separate account, and those accounts will be set up in DRGR, and there are resources available to walk you through how to set those revolving loan funds up in DRGR. Your funds will need to be held in an interest-bearing account, and you'll comply with NSP1, 2, and 3 requirements as applicable. And then any repayment to the revolving loan fund is treated as program income, subject to the program income requirements that we talked about previously. So there are some considerations that you may want to make in deciding whether a revolving loan fund is right for your program. You want to select activities that are appropriate for the size and scope of the program to ensure that there are enough funds that will revolve through the fund. So if you have an activity that doesn't generate much program income, it's probably not primed for this kind of tool. But if you have an activity that is pretty active, generating lots of program income, that might be an opportunity to use a revolving loan fund to manage that flow. You also want to consider the administrative maintenance of this revolving loan fund over time. And then policies and procedures and a monitoring plan for ensuring that all the requirements are met is recommended. You also want to note that establishing a revolving loan fund does not constitute meeting a national objective in itself, because it is not inherently an eligible activity. So you will still need to meet national objectives for those activities that are the subject of the revolving loan fund, but setting up the fund itself does not check that box for you. And then you want to consult those DRGR resources for setting up the activities in DRGR. Okay, And with that, we'll open it up to some questions. As a reminder, to ask a question by phone, you want to press *1 on your telephone keypad, and you'll be added to the queue. If your question is answered before your turn on the queue, you can press *2 to be removed. And then to ask the written questions, as George mentioned earlier, there's a Q&A tool in WebEx on the lower right-hand side of your screen, and you can type your question into that box, and then we'll read your question, and we'll get some answers for you. So with that, let's see. Do we have any questions, written questions just yet? Okay. We've got one here from Richard Knight. He asks, what happens when the grantee heirs and uses program income instead of proceeds in the development agreement and requires program income to be returned to the grantee? In the normal world, contract language prevails. Is that true in NSP?
Could you read that question again?
Sure. What happens, excuse me, what happens when the grantee heirs and uses program income instead of proceeds in a development agreement? I think they're saying they use that word program income instead of the word proceeds, I think is what they're saying, and requires that income to be returned to the grantee.
Well, I mean, that's totally fine with the, there's no requirement that the developer retain the program income, but they are allowed to, if they want to, have the developer retain the program income. Or they're allowed to have the developer return all the proceeds back to them.
Okay, now, if I think
they use a term, program income in a developer agreement, and they have the developer retain it all, I don't think we're going to come after them for that.
Okay, so the question is, I think in their particular agreement, they required that the income be returned to the grantee, and in the agreement they said it was called program income.
Yeah,
now, is
that's completely within their right.
Mm-hmm. And that income would be treated as program income once it comes back to the grantee?
Yes.
So this is a developer agreement, is that what you're saying, as opposed to a subrecipient agreement?
Yes, it sounds that way. He says a development agreement.
Right. So, yeah, I mean, the agreement rules, but the agreement can be renegotiated if that's not what they meant. But, strictly speaking, for developers, there is no program income. There's proceeds, and so maybe that's what they're worried about. But I don't think that calling it the wrong thing, makes it different necessarily. If their intention was to get it back, then it should be somewhat clear from that, or they can revise the agreement to make it clear.
Okay. And if we jumbled your question in any way, Richard, please let us know by writing back in. But I think we covered that correctly. Okay. All right. Let's see. At what point can program income be spent as regular CDBG, if ever?
At what point can program income be used as CDBG funds?
Yes.
If ever? At this point, there is no plans to make program income into CDBG funds.
Okay.
At this point.
Pretty straightforward. All right, pretty straightforward. Here's a question from Valerie. How do you?
Never. I just said not at this point.
Okay. Thank you. Question from Valerie. She asks, how do you accurately report project beneficiary data in DRGR without error messages occurring, prompting the addition of cumulative totals? Well, this is a question that comes up frequently in our Ask a Questions that we get through the DRGR Ask a Question pool. And typically, if you're getting that error message, it is usually because you've entered something that DRGR knows is not consistent with what you've entered in the past. So DRGR is pretty good at adding up the totals for income levels and race and ethnicity that you've entered previously. And if you try to change something that would make your numbers no longer reconcile, it'll give you an error message. So my suggestion would be that you submit and ask a question and provide some screenshots of the error that you're receiving and describe your issue, and then that will be assigned to one of the DRGR experts on the pool, and they'll give you a phone call and kind of walk you through what the problem might be and help you get that resolved. There is also on the Resource Exchange, if you look up prior period corrections, look up that phrase. There's some good information on how you can correct beneficiary data in your QPR, including an Excel tool. And the Excel tool allows you to enter all the data you know to be true based on your files, and then all the data that DRGR has in its reports. You can pull those reports through MicroStrategies, and then the Excel file actually calculates the changes you'd need to make in your QPR in order to reconcile any issues that might be coming up in getting your error messages. So it's a nice tool if you've got some kind of complicated issues. Okay. Kathy asks, is the $25,000 threshold net or gross?
It kind of depends on the situation, but basically any program income you receive is from the sale of a house, it's everything that you log into DRGR as program income. Now, if you're dealing with multifamily properties, you can subtract out expenses that you have in the multifamily properties before you register anything as program income.
In general, though, program income is gross revenues.
Yeah. I guess I was beating around the bush and not wanting to say that for some reason.
Well, the rental situation is one that comes up a lot, though, so it bears mentioning specifically, but everything else is just going to be gross revenues.
Okay. April asks, does the program income under $25,000 received prior to closeout have to be reported in DRGR or just tracked locally? I think she means after closeout. So does the program income that's received, if it's under $25,000, does it need to be reported in DRGR or just tracked locally?
It must be reported in DRGR.
Okay. All right. And Faith asks, in the Category 1 NSPT grantee, those are those entitlement grantees and grantees with open CDBG grant. For program income exceeding $25,000 annually, can it be used for administration? And does that mean admin for CDBG or NSP or just NSP eligible oversight?
10% of all program income earned at any point can be used for administration. So even in post-closeout, for those folks in that, Category 1, correct, is the entitlements and folks?
Yeah.
Anybody in that category, 10% of program income can be used for administration of NSP activities.
Okay, so NSP activities, not CDBG.
Right.
Yeah.
Okay. She also had a follow-up question. She says, for program income generated in that $25,001 to $249,999, that sort of span there, does that need to meet the 25% set-aside requirement?
No, that's what we're saying. It does not. Anything, under the $250,000 mark in a year, you do not need to meet the 25% set-aside requirement. But if you earn $250,001, that doesn't mean that 25% needs to meet the 25% set-aside requirement. That means that all $250,001 needs to meet the 25% set-aside requirement. So whatever, I'm not going to try to do the math very quickly here, whatever 25% of that is.
Mm-hmm.
the philosophy there was that you can't really do even a modest project with much less than $62,500. So that's why we exempted it from the set aside.
Okay, great. Craig asks, can we earn administration on a revolving loan fund for NSP? I'm not sure. Can we earn, I guess he's asking, can they take 10% of the program income earned there from the revolving loan fund for NSP? I think that's what he means, but I'm not sure. You might want to get him to clarify that question, but perhaps you've had this before, John, and you'll know what he means.
Well, I just looked it up for lump sum drawdowns, and I don't think I know you can't pay administration out of a lump sum drawdown, and I'm not sure about revolving funds. There's not much in the notice about them. Let's see. Yeah, I'm not sure about revolving funds.
Okay.
If you could write that question into the Ask a Question box, we will get you an answer.
Okay. Trevor asks, for clarification purposes on revolving loan fund accounts, if we have multifamily project that we use NSP funds to set aside our 25% set aside, is any program income that is generated from rents or repayments eligible to be used for single-family acquisitions?
Yeah, the program income is not restricted by how you earn it. The program income can be used in any activity that you want. So if you sell a bunch of single-family homes and then want to build a multifamily property or vice versa with the program income, you can.
You just have to use 25% of it for the low-income set-aside.
Right. Yeah, you could even earn all the program income and the 25% set-aside. That means only 25% of it, though, is required to go to the set-aside.
Right.
There's no restriction on how you use the program income other than that, you only get 10% for admin and the 25% set-aside.
Okay. All right. Let's see here. If a grantee establishes a revolving loan fund and capitalizes the fund with existing program income that has accrued, but then subsequently wants to remove some of that program income from the fund, is the grantee able to do so via an amendment?
The grantee shouldn't be capitalizing with program income to start out with that's on hand. You're supposed to only capitalize that with program income received after you establish the fund. The only exception is the lump sum drawdown that you mentioned earlier. Mm-hmm. So you really should not be taking up, $200,000 worth of program income that's on hand and transferring it into a revolving loan fund. You can make a loan with that and then transfer the payments back into the revolving fund.
Okay. Thank you for that clarification. Okay. Let's see here. Is program income eligible to be used to pay interest expenses on a loan taken to acquire property on an eligible census tract?
Wait, say that again? I'm sorry.
Yeah.
That's okay. Is program income eligible to be used to pay the interest expenses on a loan that they took out to acquire property?
If it's an eligible activity, and that sounds like it could be, then you can use program income for that. So you could, if you're going to pay interest on a loan for housing rehab, or write down a loan, or pay some of the interest on a multifamily loan, if those are eligible activities, then you could use line of credit funds or program income funds.
Okay, great, thank you. Do we have anyone on the line, on the phone line, that would like to ask a question?
Yes, ma'am. Your first question comes from the line of participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open. Caller, your line is open. If you're on a speakerphone, please unmute your phone.
Or if you think you're the caller, talk.
Okay, your next question again comes from the line of a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open.
This is Rick Damien. Can you all hear me?
Yes, we can.
Okay, great. All right. We have established developers to administer an ACK Rehab resale program. The proceeds from those transactions return to us, the grantee, as program income. And so say we have a small, minute remaining line of credit, but yet we're receiving a heavy dose of program income. Can we or allocate the program income to the developer to perpetuate that activity and deem it as expended, as under the first in, first out rule?
I mean, the developer or whoever has, I mean, you could set up a revolving loan fund if that's what you're trying to get at, but you can't you can't just give them the program income and say keep working.
I think you could give it to them but it would be a new activity with a specific purpose in mind. But then then your agreement with them wouldn't require the money to be returned to the city. But I don't think you could give it to them, as Hunter said. I don't think you could give it to them just outright.
Okay, it sounds more feasible that a new activity would have to be established and then starting from there,
right.
Setting it up as such.
Yep.
Okay. Okay, great. Thank you.
Sure.
Your next question comes again from the line of a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open.
Hello? Can you hear me?
Hello. Yes, we can.
Oh, go ahead.
Good. Okay. I have two-part question. The first question is, how long can we keep the program income before we spend it? Second question, the reason I'm asking this is, if when we receive the program income, we would try to spend the program income as soon as possible. And if over the course of the year, if we receive a cumulative of $251,000 by the months, by then it will be too late to have enough funds to do the 25% set aside.
That is an issue you have to be cautious of. I mean, you are able to retain the program income and decide not to spend it until next year, but you do need to demonstrate, you know, if you go over the $250,001, that you've done a set-aside project. So it may be in a situation where if you think you're going to be close this year, you just want to spend all those funds on a house or, you know, some sort of project that will benefit or house folks at 50% AMI or less.
But you don't have to spend it in the same year that you earn it.
That's right. That's true.
Is there time limit how long we can keep that before we spend the first dollars?
Well, you could keep it until you have a project.
Yeah. Like you can't spend your line of credit funds if you still have program income on hand.
Yeah, well, that's not our case. We're just working on the program. All right. Thank you.
Your next question comes from a line of a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open. Caller, your line is open.
Hi, this is Nira.
Hello.
Hi, I have a follow-up question to the question regarding capitalizing revolving loan funds. You said that you cannot capitalize using existing program income. Now, to capitalize, would you have to use program income that is earned only after the revolving loan fund has been created?
Yes.
And that could be earned in a different activity.
From where it was earned, yes. So if you're going to have let's say a home rehab, you know, loan program that you're going to use, or ACK rehab, for your revolving fund. Yeah, if you might get program income from the sale of a rental property, that doesn't matter. But once it goes into that fund, then so you have to spend that money, and then when you put it into the revolving loan fund, then you'll continue to receive the proceeds of those activities from from the fund's activities, and keep it going, keep it revolving. But yeah, you have to establish it first before you can. So that's the distinction. You can't sort of stockpile it and then shift it over. You have to establish it and then earn program income and then put it into that fund. And then once it's in that fund, it has to continue to be used for those activities, even if it wasn't originally from one of those activities.
Okay, so it can be earned from a different activity. It just has to have been earned after the revolving loan fund was established.
Right, and then it has to be spent only on the activities in the revolving loan fund.
Okay.
Your next question comes from the line again from a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open.
Inalbert Ramos.
Hello.
Hi, can you hear me?
Yes, we can.
Oh, thanks. Just a quick question. Basically, is wondering if you can use we can use demolition expenses of about $300,000 to meet the 25% set aside requirement.
No, you have to. The 25% set requirement. Sorry, the 25% set aside requirement specifically requires that you house individuals at 50% area median income or less. So demolition would not meet that.
Okay, that's what I told my boss, so I'm going to show this recording to him. Thank you so much.
No problem.
All right, bye-bye.
There are no further questions from the phone at this time.
Okay, excellent. Thank you.
Hey, Jennifer, this is
Yes.
George. I'm looking at the questions that are coming in the written Q&A, and I just want to let folks know if you're submitting your questions on the Q&A panel, we're receiving a lot of questions. So if we haven't gotten to yours right away, it doesn't mean we've forgotten it. It just means that it's in the queue, and we'll get to it eventually. And so apologies. Some folks are just starting to write in their question 2 or 3 times. So I just wanted to let everyone know we're going to get to all of them.
Yes, we will. One thing I wanted to go back to slide 8 here, because there's a typo on this slide here. It says that the new waiver allows NSP2 grantees to spend their program income in advance of line of credit funds. Of course, that should be backwards because that's the whole point of the waiver. So the new waiver allows NSP grantees to spend their line of credit funds before program income. And I corrected that in the presentation, but a couple people I think are going back looking through the slides, and some of the questions relate to this. So I just wanted to highlight this. Again, the waiver allows you to spend your line of credit funds before program income. And we'll fix this on the slide before we post it on the website. I just want to clear that up for folks. And that also helps to answer some of the questions that we have here. Okay. So this question is from Angela. She asks, we have a property management company that manages 2 of our NSP apartment buildings. At the end of the month, they send us approximately $4,000 of the rental income received. Is the program income that we receive the amount they sent to us or the total monthly rent?
The amount they sent to you, because basically what we're saying is that you're going to have expenses at that multifamily property that it sounds like the management company is handling for, their fees, as well as, any, maybe, they have to replace a water heater or something, and it comes out of those proceeds that they get from the rents. So with rentals, we're only looking at what your net income is.
Basically, net operating income is what we would consider to be the So there's a policy alert that came out in July of 2011 that goes into that calculation if you want to find that, follow that a little bit further. But those are considered to be costs incidental to the generation of the fund, and they are exempt from being considered part of the program income.
Thank you. Let's pop the program income resources slide back up there for a minute so you can take a look at some of those dates. Okay. April asks, does program income, and I think we touched on this a bit, but let's ask her question here. Does program income under $25,000 post-closeout have to be reported in DRGR?
Yes.
Okay. All right.
But it still it might still be miscellaneous income if you're a nonprofit or something like that, but you do have to report it.
Yeah.
Okay. And,
that's
all
good.
right. And that is in DRGR, not IDIS.
Right.
For other questions.
Yeah.
Okay. And program income is, let's see, Angelica states, program income is not limited to target areas. Is this different than the original grant funds?
No, this is only after closeout.
Mm-hmm.
This is not not something that you would face pre-closeout. But you still, in many cases, are going to need to have to, let folks know through some sort of notification process. And I would talk to your field office about that before you did it. It really, quite honestly, it deals more with NSP2 because you're no longer going to have to come and re-rate your application and things like that.
Okay. Great. Okay, David asks, we structured NSP1 and NSP3 activities to emphasize rental properties through developers for low and very low income residents, and we anticipate very little program income. What are your suggestions for funding the required ongoing monitoring?
No, that's a tough one. I mean, you can use CDBG, for example, but that's just taking it out of another program. There have been some grantees that have charged subrecipients like a monitoring fee, basically. I don't know. If you're monitoring low-income housing projects, then they typically don't have a lot of extra cash flow to be paying fees with. So, I mean, you can hold program income. If you do get some program income, you can hold it for that sort of purpose after closeout. But yeah, it's an unfunded problem, I think. So maybe some of the other callers could suggest what they're doing. I'd be interested to hear that.
Be great. Yes, if you have suggestions, feel free to call in and share. Scott asks, is the NSP2 program income waiver retroactive at all? If program income was drawn on the 26th before the waiver was released, can we cancel that voucher and draw from the line of credit?
No, unfortunately you cannot. The waiver was signed on the 28th of January, and any program, it only goes into effect, it only affects the program income from that day forward.
Okay. Carol asks, if a grantee's NSP program income is less than $25,000, can it be added to CDBG program income receipt? So if the grantee did this, would the NSP program income that was added to the CDBG program income become CDBG funds?
If it's under that $25,000 limit, yes. But remember, much like the other grantee that called in a few minutes ago asked, what happens if we go over? You're going to have issues if you get over that $25,000 limit during that year.
Mm-hmm. Yes.
mean, you could add it to your CDBG. You could do other things with it too. It really is unrestricted.
Yeah.
Great. Don asks, if program income is received from a project that has both home and NSP funds involved, and the program income is apportioned into home PI and NSP PI, does one just report the NSP designated program income in DRGR, or does it report both or all of the program income into DRGR?
Just the NSP PI.
Yeah, the home PI would go into IDIS.
Okay. Great. All right. Debbie asks, referring to the second option under the NSP grantee identity on the post-closeout provisions table that we showed earlier, it states that non-entitlements with no CDBG grant open at closeout. Is this referring to CDBG grants, referring to the local government CDBG grant as an entitlement community?
Right. There were about 30 NSP3 grantees that received a grant that did not have an entitlement amount. There was non-entitlement communities. They get funds from the state or whatever.
Okay. So this is referring to those specific grantees that were non-entitlement communities. It's not referring back to the local government CDBG grant.
No, and even those non-entitlements, if they have an open state grant, then we're going to sort of consider that to be a line that's still open to us. So that's why we say closed grants, and they're not entitlements. So you would know if you're in that category. There's some in Florida. There's a couple in California. There's some in Ohio, I think, maybe a few in Michigan.
Okay. Great. Thank you. Do you have anybody on the phone line?
Yes, ma'am. Your next question comes from the line of a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open.
This is Hal Cooper from LA County. We want to know, when does the year start for accumulating the $25,000 total? When does it start and when does it end?
You're going to work with your field office to determine what that year is. What's going to happen is you're going to close out your grant, and basically you're going to, whatever random day that takes place is going to be the start of your first year. And then your first year will end so that you can line up all this reporting with, all your other CDBG reporting. Will end at that point. So that first year might be only a couple months. It might be closer, almost a year, depending on when you do close out your grant. And then from that point on, you'll use that date when everything else that you have to report to HUD is, and sort of it falls into your CDBG year.
Yes. Okay, great.
Does that make sense?
Yep. Thank you.
No problem. But you're going to basically work with your field office and figure that out.
There are no further audio questions at this time.
Okay, thank you. Okay, we'll go back to the written questions then. Let's see. Okay. Does it have to be explicitly stated in the development partner agreement who retains program income? If it doesn't, must it be amended, or can it be inferred that the developer keeps it?
Yeah, I mean, you probably should have that in your agreement with your developer, so that you don't have issues with your developer or with anyone else.
Your auditors who don't infer very well.
Yeah, exactly.
You could do it with like a letter agreement or something, not necessarily have to rewrite the entire agreement if that's the only issue.
Okay, thank you. Angela asks, what other funds can be used to pay for administrative costs related to closeout if no NSP administrative funds are available?
The question of the afternoon.
Yeah, and I don't think it's just the afternoon, John.
Bake sales?
You know, that's obviously an issue that we realize there is, but unfortunately I don't think there really is a good answer out there.
Yeah. Again, if anybody's listening and has ideas, feel free to participate and share.
One thing that we did say, and then I got to leave for an appointment, is that you know, your 10% administrative budget is really an allocation, and it doesn't all have to be spent at once. And so if you've spent most of your grant funds on hard activities, on hard costs, for example, and then you still have, in effect, budget capacity, you know, for another $50,000 or $100,000 worth of administrative costs, you can carry that budget capacity forward so that when you do get program income, you might be able to use most of it or all of it for that purpose, you know, assuming that you've met your other requirements. So that's one thing that we've, you know, sort of carved out, but that still requires you to have some source of revenue, and if there's a lot of places that don't have that, I realize.
Thank you. Okay, Sean asks, after closeout, must program income, not program income in a revolving phone, but regular program income, be retained in an interest-bearing account?
Program income not in a RLF?
Correct.
John, I think the answer to that is yes, is it not?
Yeah, yes.
Okay.
Okay, great. Moving along. Let's see. What if we have met the original NSP1 25% set aside and have an agreement with the nonprofit to use the remaining $250,000 in program income to acquire foreclosed homes, rehab, and resell to households at 50% AMI? Could we close the NSP grant and continue with the nonprofit?
Is that $250,000 line of credit funds? Is that what they're saying? Or well, let me put it this way then, rather than asking that. Basically, the requirement is that to meet the 25% set aside, it's not just that you've built a house that you say you're going to put somebody in who is at or below 50% AMI. You actually need to have somebody living in that house and have met a national objective for that house. So, you know, if to close out, all you need to be able to do is demonstrate that you've spent an amount equal to 25% of your initial grant allocation to house folks at 50% AMI or less. But that means somebody needs to be in the house. And then you have 3 years to meet the requirement from the date of closeout for anybody who, for the amount you've generated in program income. So if you have $1 million grant and you earned $100,000 in program income before you closed out, you need to spend $250,000 on the 25% set aside by the day of closeout, and then another 25%, $25,000 for that $100,000 in PI that you earned 3 years past from the date of closeout. So again, the requirement is not just that you've spent the funds and you've built the unit. The requirement is that there's someone in that unit.
Great. Thank you. And Rhonda, if you have any follow-up questions from that, feel free to submit it or call in, and we can clarify further. We've got a question asking, how long can we keep program income before we spend it?
Really, as long as you want. There's no requirement that you spend program income, within a certain amount of time. But the thing is, the next project you have to spend that program income on that next project. But there's definitely, as John was talking about earlier, there are definitely people who have grantees out there who've sort of set up their books because they've allowed themselves the spending capacity due to the for admin to use the program income they're getting and sitting on it and waiting until they close out so that they can close the grant out. And they're not spending any other funds. They have no projects. They're just waiting for people to buy homes, that type of stuff, and then they can ready to close out, and then they'll spend that funded.
Okay, thank you. Thomas asks, a grantee states home buyer units sold did not generate program income. All proceeds paid of the construction line of credit used by the nonprofit. Let me see. Let me rephrase this because it's written a little bit not exactly like a question. Okay, a grantee. Okay, this is the grantee is saying that the home buyer unit sold did not generate program income, and the sale proceeds of the a construction line of credit were used by a nonprofit. They have NSP3 funds that were used for construction, gap financing, and down payment assistance. And so he wants to know if that's actually a possible scenario. Sounds like he's got a little bit of a hypothetical here that it might be good to get a little more detail and maybe even submit this as an ask a question.
Yeah, I think that's probably a good idea.
Yeah, because this one, I'm not sure we have enough information here to really answer the question properly. Okay. Let's see. Robin asks, what can you do with program income from the sale of a home that's not enough to buy and repair another house?
So either you wait and you generate more program income, or you find a home or a house that you're going to invest other funding sources in, and you can tag on that NSP funding source.
Great, thank you. Angelica asks, I have about $400,000 in admin still available in my line of credit. I plan to use program income to do an eligible activity. Can I still draw my admin from the original line of credit for program income activities even though I have program income on hand?
You have to use the program income first. But if you have, remember, we're not saying you have again, let's go back to this where we said you had the $1 million grant and the $100,000 worth of program income. We're not saying that you have sort of two buckets of program income, that $100,000 from the $1 million grant and then the $10,000 from program income of admin funds. You have the spending capacity in that case of $110,000 for admin. So there are a couple ways you can do it. You can spend all of your program income on admin, just as long as you also remember that you need to spend 25% of that $100,000, so that another $25,000 on the 25% set aside. So if you spent $300,000 or $300,000 from your line of credit on a 25% set aside project, so then you basically you have the credit from those line or the capacity from those line of credit funds that you spend on that set-aside project to deal with any program income you earn, or the 25% from that $100,000. I'm not sure if I'm being very clear here, but we're just looking at spending capacity. So we don't care where the dollar came from, just as long as you have that capacity.
Mm-hmm.
That clear? I don't know. I'm sorry.
Yes,
I'm not sure if I was very
clear. I thought it was clear to me. I think you helped kind of shed some light on the fact that it's not necessarily about where the dollars came from. It's about meeting that dollar figure.
Exactly.
Yeah. And for NSP1 and 3 grantees, when you're pulling down funds, if you have program income on hand, you will have to use that first in order to fund those amounts up to that dollar figure. For NSP2 grantees, we talked about that waiver before, and if you follow the DRGR instructions to set up those new accounts, you'll be able to access your line of credit funds more quickly than you would have under the general program income rule. Okay. We got a question from Josh. He asks, if you have already spent, say, 30% of your line of credit plus program income on set-aside activities, do you need to spend more money on low-income beneficiaries for program income earned after closeout if that program income earned does not push you below the 25% for the whole grant in aggregate? I think he's asking a little bit about sort of banking.
Yeah, unfortunately, the answer to that question is no. You're going to start over from scratch once you've met all the 25% set-aside requirements. So the day of closeout, you now, we're looking at it as you have, zero requirement. You're basically starting over the day of closeout. Now, you may have that 3-year window to meet that program income requirement, but it sounds like you don't have that situation, Josh. But yeah, you can't bank before closeout for future PI.
Mm-hmm. Okay. This question is from Glory. She asks, at the time of closeout, if there is a program income balance that has already met the set-aside requirement, will DRGR have separate program income reports to track the program income earned following closeout to avoid having to meet the set-aside again?
Yeah, there are reports you can pull, and we're going to do a webinar here in the near future sort of about DRGR and closeout, and it's probably a good thing to highlight during that point, at that point. But there are reports that you can pull that will show you when and what year you earned program income. So you'll have to use something along those lines to sort of help you track where you stand.
Great, thank you. Mark asks a question that's not specific about program income, but he asks, can NSP funds be used to pay for security guards to guard NSP properties that are waiting to be sold? They're having some problems with theft and vandalism.
It could come out of your admin expenses. Whether or not it could be considered a development cost or a development cost, I don't think so, but write that question in because that is a really good question, and I don't know the answer right off the top of my head, and I would want to get you the right answer to that. But it definitely can come out of your admin.
Okay, great, thank you. Sean, do we have anybody on the line? Oh, sorry, go ahead.
Let me go back to this just a second. In general, most security costs can be considered part of the total development cost, but because we're talking about like hiring a security firm, I just want to double check.
Mhm. Yeah. So write that in to ask a question, and we'll get you some more feedback. Sean, is there anybody on the phone line waiting?
Yes, ma'am. Your next question comes from a line of a participant whose information was unable to gather. Caller, please state your first and last name. Your line is open. Caller, your line is open.
Hello? Can you hear me?
Hello. Yes, we
Hi.
can.
Okay, wasn't sure if it was for me. This is Lorraine Pollock with South Dakota. And when we started doing NSP, some of the clinics, what we were talking about doing was pretty much what John indicated earlier. We would go ahead and budget purposes, we would expend more of our admin dollars and then replenish that account with program income. I understand that HUD has not come with a date for closeout deadlines, which is good. But what we're running into as an issue now is we still have entitlement that we want to draw down, but since we had so much program income and use that first, we're kind of stuck because now we've got program income still coming in that's covering our admin expenses, but we want to close out, but we don't want to walk away from the entitlement. So I'm kind of just trying to figure out how to get over this obstacle.
When you say entitlement, you mean your line of credit funds, correct?
Line of credit, yes, yes.
You know, that is a problem that a lot of folks face, and I mean, if you're only using admin, maybe you want to consider doing a small project to sort of pull, drip down or expend your line of credit funds or your program income funds so you can reach those line of credit funds. But, you know, you either need to, you know, sort of find a way to spend more admin funds or you know, do another project of some sort.
Yeah.
And
I guess we were just trying to go ahead.
Yeah, trying to avoid that so you can, because you have to meet a national objective where you can close out.
Right. Well, and we were just looking at the futuristic, you know, admin trying to cover the costs for compliance going forward, and so we were trying to do this. And I guess as long as there's really not a deadline for closeout, then we still have some flexibility. But I do see that as being an issue, unless, like you said, we do another project.
Yeah, and remember, I mean, you can always fund a partial project in the sense that, you know, you're about to do a home project, and you can, you know that you can dump this $60,000 worth of NSP funds into it, and it will allow you to, you know, get to those line of credit funds. So it doesn't have to be like a standalone NSP project.
Right. Okay. I guess we'll look into doing that. Thank you.
No problem.
Your next question comes from the line of a participant whose information was unable to be gathered. Caller, please state your first and last name. Your line is open. Caller, your line is open. And there are no further questions from the phones at this time.
All right, thank you. We do have more written questions. This question is from Don. He asks, the exemption from the 25% set aside for program income that is less than $250,000 per year. If I understand that correctly, that only applies to post-grant closeout. Is that right?
That is correct, yes.
Okay. But the program income less than $250,000 per year still needs to meet the set-aside requirement if the grant has not yet closed.
That's correct. So every dollar you earn before closeout needs to meet the 25% set-aside with. You need to meet the 25% set-aside with.
Great.
Or 25% of every dollar.
Thank you. Okay, Rhonda says, what if I have met the original NSP1 25% set aside and have an agreement? I actually think we answered this one previously. Yeah, we already answered this one. Sorry about that. Tim asks, for NSP1, how much flexibility is there for meeting the 25% set aside after closeout, or does it have to be met annually?
Well, how much flexibility are they asking? Like, how long do they have?
Yeah, I think so.
I mean, the situation is going to be that you're eventually going to need to demonstrate that you've done it. So the field offices will, you know, will want to see some progress. You're going to be reporting annually, and they'll be able to see where you stand. So, I mean, there can be repercussions in the future, but it's not a requirement that, you know, 2015 I earned $260,000 worth of program income, and I've already closed out. You know, I have to meet the 25% set aside before 2016 ends. It's not like that, but you know, we will expect in the you know, reasonable future that you've met that requirement.
Thank you. Lorraine asks, we'll be following the Category 1 section for a post-closeout requirement. And so assuming that she's an entitlement or a non-entitlement with an open CDBG grant. The program income will vary by year based on loan repayments. How would we handle reporting when one year we are under $25,000, but the next year we're over $25,000, but not enough money to fund a project?
Well, I mean, again, the reporting will be handled in DRGR, and you will be able to pull that report we were just talking about, which will show you how much program income you've earned every year. But you're going to need, you know, you don't have to fund a full, it doesn't need to be a full NSP project. It can be a NSP, CDBG, and home project, or it can be, you know, NSP and a tax credit project, or however you want to do it. But you will need to use those funds for some sort of NSP purpose.
scrolling through. We've answered some of these questions already. Okay. We're doing pretty good on answering the questions. Let's see here. I know we've got more in the queue though. Okay. Brenda asks, since we have to use program income before grant funds, how can we spend the full 10% of program income for administration if you already used up all your program income on a project?
This goes back to the capacity. You know, if I earn $100,000 this year, I know I have $10,000 worth of admin capacity. So I could spend that whole $100,000 on a project and then bring in another $100,000 next year. Now I have, since I haven't spent any admin funds this year, now I have $20,000 worth of admin capacity next year. We don't require that every dollar you get in, you peel off 10 cents for admin and you peel off a quarter for the 25% set aside. All we're saying is that you just, when every dollar you earn, you have the capacity for 10% of admin, and then you have to expend 25 cents at some point for that 25% set aside.
Okay. Thank you for that clarification. Got a couple more written questions here. Okay. Somebody's asking about DRGR here. He asks, has DRGR been fixed to work with various browsers? At one point, I was told to only use Internet Explorer 8, that Chrome, Foxfire, and even IE9 were all causing problems. Unfortunately, that has not been resolved, except that there is a pretty easy workaround, and that is to set your browser to compatibility view. That said, you always want to be using Internet Explorer. That is the browser that works most optimally for DRGR. So start in Internet Explorer, but if you happen to be running Internet Explorer 11, you set your browser to compatibility mode, and you can Google that, and then it'll give you some really easy instructions. It's not hard at all. But if you set your browser to compatibility mode, you should be able to use DRGR just like it's working in Internet Explorer 8. So if you're still having trouble with that, though, feel free to submit and ask a question to the DRGR section, and somebody will take a closer look at that for you. Cindy's asking, must the program income received prior to the waiver be receipted and used before line of credit funds?
Yes.
Thank you. Angela asks, we were an NSP1 grantee under the state, but we're also a CDBG entitlement. We do not have access to or report in DRGR. We have been permitted to keep our program income. How would we report the program income earned?
So you're a subrecipient in NSP, is that what they're saying?
Yeah, she's a subrecipient under the state.
Well, the state needs to report your program income. There are, and that's a good thing to continue to mention. I know a lot of folks knew that we tried earlier in the program to allow after closeout for states to be able to turn their program income over to the entitlement communities and other communities that may earn it. Unfortunately, we are not allowed to do that. So the states need to earn or need to report on all program income they earn or their subrecipients earn. Mm-hmm. So you should be giving your information to the state so that they can plug it into DRGR.
Okay, great.
And the other thing, you know, we talked about this $25,000 rule for NSP. That applies to states and entitlement communities and nonprofits. So it applies to everybody. I know in the regular CDBG program, the states have you know, $35,000 limit. In NSP, since we use the entitlement definition of program income, everybody's under the sort of the entitlement rules for program income.
Thank you. April asks, Regarding the requirement that income under $25,000 be treated as unrestricted use, does this apply to open NSP grants or just after closeout?
Just after closeout.
Okay. Carol says she understands that post-closeout program income is reported in DRGR regardless of the amount earned, but is the spending of it also reported in DRGR?
Yes. The closeout notice does talk about the fact that at some point we're going to switch over to IDIS. That is something that is way, way, way off in the future. So for this foreseeable future, everyone's going to be continue to report everything, use and program income earned into DRGR. I will point out that once you close out, you no longer need to do quarterly performance reports, but only need to do annually, or annual performance reports.
Give you a little bit of headache. Okay, Scott asks, in the scenario where a grantee had $1 million grant and earned $100,000 in program income, you stated that at closeout, $250,000 needed to be spent towards the 25% set aside. Can that $250,000 be line of credit and program income combined, or is that $250,000 from the line of credit specifically?
No, it can be combined. So it can be all the $100,000 of program income and then $150,000 from line of credit. We don't really care how you where you get the NSP funds from to meet that requirement. We just want you to meet that requirement. And that goes then if you have that 3 years that you need to meet that 25% set aside for that $100,000 in program income, you can meet that requirement from program income you earn after you close out. But it's, as I like to say, it's like, and Jennifer, I think you came up with this analogy, it's like being sick at home from school. You can get an extension for your homework, but you still need to do all the other homework that you continue to get when you go back to school. So,
that's right.
Yeah, so you can spend the 25% set aside from program income you've now earned post-closeout, but you still need to meet the 25% set aside requirement for any program income you earn post-closeout. So it's like an extension in homework. I think that's the best way to look at it.
Yeah. And Stephen asked sort of a related question that I think we may need to clarify for him a bit. He says, to clarify, the PI earned prior to closeout must be spent within 3 years of the close date, and PI received after closeout does not have an expenditure deadline. I think he's got that a little confused. It's not that you need to spend the program income within 3 years after the closeout date. You need to meet the 25% set aside requirement for the program income you had earned prior to closeout within the 3 years. For program income received after closeout, there is no deadline for spending that program income. So that 3-year rule relates to meeting the 25% set aside requirement, not spending. Okay, Carolyn asks, once we started selling our rehab properties and receiving program income, we never drew down all the funds in lock. We have expended more than the original grant amount, but did not use all the funds in lock. Can we just return unspent funds to HUD?
Yes, and when you close out, what will happen is any funds left in your line of credit will be recaptured. So if you don't plan on spending it, and quite honestly, a lot of grantees are going to end up with like, $1,000 or $50 in the line of credit that they're just going to lose, and that's completely acceptable.
Okay, great. Angelica asks, I currently have an approved HUD plan to use some of my NSP1 and 3 program income to conduct building abatement activities. I heard you say that if the program is closed out, which my 1SP program is, I am no longer limited to eligible areas. Is that correct?
You need to talk to your field office about that. I'm just going to put it that way because it depends. We could do an entire webinar just on that subject, and so I just urge you to contact your field office. In general, the rule is sort of yes, but you need to ensure that you have done a number of other steps, even though you're not. Basically, I think the best way to look at it, for NSP1 and NSP3, even though the answer is yes, you're still going to have to go through pretty much the same process you are right now. So you will still be working, even though technically you don't need to work in the target areas, you're going to, what you end up doing at the end of the day is going to look a lot like, it's going to look a lot like what you're already doing. For NSP2, the big difference is it's a competitive program, so what you've been doing is coming back to HUD headquarters and having your application re-rated. You will no longer have to go through that step, but you're still going to have to do public notice and all the other stuff. So, even though for 1 and 3, the answer is you don't need to work in your target area, you're going to end up doing pretty much exactly what you did today to work in your target area, even though you're not doing it, if you see what I'm trying to say.
Yeah.
So just talk to your field office.
All right, thank you. Deborah asks, after closeout, what is required of developers as far as reporting and compliance?
Well, the big requirement is, you still need to ensure you're enforcing affordability requirements, and you're going to need to report on those houses with affordability requirements on a yearly basis, basically saying whether or not, that they're still in the program. So that's going to be sort of the big requirement. Now, the developer may not need to do that if you plan on doing it, but I would probably set up a way for the developer or set up some sort of system that somebody's telling me whether or not that house is sold, whether it be through the lien or however you want to do it.
Okay. Sean, do we have any callers on the line?
No, ma'am, not at this time.
Okay. We have a question from Carol. She says, post-closeout program income and spending is reported in DRGR. She understands that. If NSP program income is less than $25,000 and receipted as program income in CDBG, the spending is also reported in IDIS. Is this going to be double reporting? There may be some confusion there.
Yeah. You still need to report the $25,000 or whatever the amount is in DRGR. It then becomes sort of, if it's less than that $25,000, it's basically, miscellaneous revenue. So, I mean, I think how you're going to report that if you do CDBG activities with it, I think it's more of a question the entitlements folks.
Okay.
I'm not even
Should
sure
they submit that one?
Yeah, I would submit that through an AAQ.
Great. Okay. Deborah has, sorry. Got a few more questions rolling in here. A previous inquiry indicated that program income will be used to conduct building abatement activities. Does that mean program income is not subject to the same eligible uses as the initial grant? I think the indication of the uses of program income confused me.
Yeah, the program income still needs to meet a national objective. I wasn't exactly sure what they meant by abatement activities, so I assumed whatever they meant was still meeting a national objective, but that is a very valid point.
Okay.
Unless, yeah, you still got to meet a national objective.
Yes. Thank you. Let's see. Carolyn asks, may I return unspent program income to HUD?
Huh.
Never had that one before, did you?
I have not had that one before, and I don't know the answer to that. If you could submit that question through our Ask a Question site, or if Paul or Larry know the answer to that, yeah, I have no idea. That is a great question. You stumped me there.
Save the best for the end. Well, definitely submit that one, Carol, so that we can all hear the answer. Okay. Okay, let's see. Deborah, I think, may have asked a question previously, and I'm not finding it here in the queue, but she has another follow-up question. She says, what else is reported annually?
Well, program income earned.
Mm-hmm.
It's basically going to be the exact same report as your current QPR, except that it will be done annually. If that's what they
Jennifer,
do.
I think she asked specifically about environmental things.
Yeah, but I think that question was referring to even an earlier question still. She says, that was reporting, but what about compliance? I'm not sure which the reporting question was about. She says, are environmental still required? I think filing closeout she might be asking.
Yeah, and
both in reference to developers. She just added just in reference to developers.
Oh, okay.
Environmental is still going to need to be done for the folks in that category 1.
Okay, so if a developer is getting money from a grantee that's in that category 1, they'll still need to comply with environmental requirements. Basically, if you're in category 1 and you earn program income, the rules are exactly the same as today as they are the day after you close out. Mm-hmm. Yes. Okay. Deborah, does that answer your question? If I can see you're still there, so yep, okay, she says thank you. Great. Okay. Sean, anybody on the phone line?
No, ma'am, not at this time.
Okay. George, did you notice if I missed any of these questions? We have quite a bit of questions here today. Did I miss any?
No, I was trying to follow along with you, and I think that you did okay. There was one question we received a long time ago via the chat function, and this might have been addressed, but I'll repeat it now. It says, Shelley asked, I know we had a closeout period, but we are not close to actually closing out. Is there a certain date we have to move money to a separate account?
I guess what they're asking is there a requirement to close out by a certain date? And the answer to that is no. I will point out, though, that as we talked about earlier, there are, for NSP2 grantees, there is a date, September 30th of this year, at the end of this fiscal year. Their accounts, all the NSP2 accounts, their line of credit accounts are swept by Treasury. So we can't, that's in the statute, and we can't get around that sweep. So we were able to get a waiver to allow those folks to spend line of credit funds before program income. So if you're in that category, one of those 42 that we list, and it's only the folks, NSP2 grantees with a substantial amount left in their line of credit. If you're one of those 42, then yeah, you have to do this, this sort of creating a new account. But if you're an NSP1 or an NSP3 grantee and you still have funds in your line of credit, you just, you just continue on like any day, like every day. There's no requirement to spend those funds, or no time limit to spend those funds. There's a requirement to spend those funds before you close out, but there's no clock ticking like the NSP2 folks.
Yeah. And life doesn't change too much after closeout for most people, so
yeah.
There's no
full
real
performance reporting rather than quarterly.
Right.
And as somebody who reviews some of the grantees' quarterly performance reports, I can assure you that I will also find it better when you start reporting annually, and I think you all probably will too.
Okay, great. Sean, we didn't get anybody else to join us on the phone, did we?
No, ma'am.
Okay, thank you. It looks like that is the end of our questions, although somebody usually chimes in here as soon as I say that, so let's give them a second. May have worn them out today. Okay, well, for those of you who are still hanging on the line here, I wanted to remind you that of the resources available to you at the 1CPD Resource Exchange. You also have the DRGR Frequently Asked Questions, where you can go to look at some of those issues that are pretty common, and you may be able to get an answer there quickly. If you cannot find an answer there are training materials available for DRGR and NSP, those webinars we talked about at the beginning of today's presentation. You can always submit a question via Ask a Question. We mentioned that a few times this afternoon. It's a good way to get some one-on-one feedback on a specific issue that may be a more nuanced than something that one of the general FAQs can address. And specifically for DRGR, if you submit and ask a question, you get some almost like a mini technical assistance. So if you have a problem that's bigger than that, you can request a technical assistance engagement through the 1CPD Resource Exchange as well. And finally, we'd like to invite you to give us your feedback. We always like to hear what we can do better and what you enjoyed so that we can take that into consideration for future webinars. There's a link here on this last slide. If you just click on that and answer a few short questions, that would be very helpful to us. Just a reminder here, if we get any policy-oriented questions in the surveys, we always funnel them over to Hunter and the guys there in the NSP shop. But if you put a policy-related question in there, it's going to take a little longer for it to get to the right people. So better off to send and ask a question. Those are always answered within a few days.
Jennifer, this is George. Just a reminder that they probably can't click on that link on the slide to get to the survey, but once the webinar ends, you'll be taken to it.
Ah, very good. Thank you. All right. Well, with that, we'll conclude today's webinar. Thanks, everybody, for joining.
Thank you.
This concludes today's conference call. You may now disconnect.